Hi, this is Matt Amberson of Option Research and Technology Services, and today I'd like to go over our Special Situations Earnings Report, and I'll title this Earnings and Option Behavior. And again, this is for educational purposes. We're not a BD, this isn't advice. So here's the sample report that we email out on a daily basis. It lists a symbol name, for example, Archer Daniels Midland ADM. Average option volume for the last 20 days, Archer Daniels had 17,723. The earnings date. Now this report came out the first trading day of February, and the earnings date of 2/4 before the open is Archer Daniels Midland's. The price of the stock when we made this report was 39.52. The expected move based on a calculation of expected volatility is 1.93. The implied volatility for month 2 is 31.8%. The ORATs divided by implied means our ORATs value of expected volatility divided by implied. So 77% means that this is undervalued. The option return and positive over total is the focus of this report of the special situations. What we'll be going over in this presentation is what constitutes a special situation, special option situation, and when that particular situation has occurred historically, we will want to see how well the stock did. Now the thinking behind this report is that there is leakage, especially around earnings. For example, people like accountants, financiers will know whether a earnings is going to be near expectations or far away from expectations, and often in the options market they will trade around these opinions or of inside information. And what we'll want to do is identify what is going on in a stock. If there is some outlying special situation, look at what happened historically when these similar special situations occurred and try to make a profitable trading decision based on it. All right, so my firm, Option Research and Technology, has large databases going back many years. So we will look back 20 quarters and we will identify special situations based on either implied volatility, the curve changing, where this might indicate an overbuying of calls, selling of calls, buying of puts, selling of puts. So we will see this by the curve changing the slope. Another thing that might happen if there is leakage and someone's doing a lot of option activity that's unusual is the implied volatility level may change. So if there's a lot of buying, the implied would go up. If there's a lot of selling, the implied would go down near the earnings date. And we will study that historically. Also, what might happen is the value of the implied might be under expectations or over expectations in some manner greater than a standard deviation, and we'll want to note that if the times when it's very overvalued have actually produced a good return or undervalued produced a good return, we'll want to note that. And so these are anomalies that we're going to be looking for, and we're going to be testing the profitability around these anomalies. So I'd like to explain the first possible anomalous situation that could occur is a change in slope. So here we're looking at a graph of Microsoft monthly Jan of 2012 implied volatility, where on the x-axis we have the low strikes on the left and the high strikes on the right, and we have implied volatility on the y-axis. This is a traditional looking smirk of an implied volatility smile. The brown dots represent actual individual strikes. The pink line represents our smooth curve going through those, and then the aqua blue line, the tangent at the 50 delta, shows the slope of the put-call relationship. Now, what we're going to be observing is when that slope changes precipitously, we're going to want to note that and see if there's any leakage or profitable situation that occurred when that happened. So what we're saying is a steepening of this, meaning the left side goes up, that's usually out of the money puts are being purchased. A shallowing, meaning the right side goes up relative to the left side, meaning that calls might be purchased in relation to puts. Another anomalous situation is just a change in volatility, and that would just have the entire slope going up or down, and that just indicates general buying or selling. Another is assessing how the implied volatility is relative to an expected implied volatility. ORATS does a expectation based on historical relationships of volatility, and if the implied volatility is different from this expectation, we will note that. So what I'd like to do in this presentation is look at the last 5 reports that happened the first of each month and simulate doing a strategy that you might do if you were noticing that it made sense to own options, or if you thought that it might make sense to sell options. We're going to look at strategies and how well they would have performed historically, and I'll explain it in the first one. So the first monthly report I'm going to look at, and again these come out daily, but I'm just kind of randomly choosing reports, came out on November 1st here, and indicated, what is that, 7 names that have special situations that could be interesting. And again, we're looking at when positive divided by total means there were 7 special situations that have happened historically. And again, the 3 special situations are a change in slope over a standard deviation, a rise or fall in implied volatility, or an extremely under or overvalued situation. That happened 7 times in Kellogg Company, and if you would have owned options all of those 7 times, you would have made money only 2 times, which is to say the converse is you would have made money selling options 5 of 7 times. And so we're going to look at this as a potential trading opportunity. What we're also going to look at is the ORATS divided by implied. So our ORATS expected volatility, if we're selling it, needs to be below the implied, or it needs to be below 1. In Kellogg's case it is, in SBAC it is not, so we have no simulation here. So basically what we're doing is we are going to simulate an iron butterfly. It's a relatively safe strategy to sell options, and so we simulate, and these are just mid-market calculations. You may not be able to, just the disclaimer that you may not be able to get this in the market. We're not putting in any slippage or commissions in this. So, and we measure it near the close on the 1st, which is when these reports come out during the day, and then we measure the resulting or closing trade after earnings date. So if it happened before, we would exit on the 4th. If it happened after, we would exit on the 5th. So for example, you would have sold the iron butterfly for $1.30, and then after earnings you were able to buy it back for 95 cents. So we got a profit on that one of 35 cents. This is this profit percentage is just a simple percentage of 35 cents divided by 1.3. It's not exactly how you would calculate it. You would calculate it based on your margin. This is just a kind of a quick and dirty way to look at the percentage. So if there's a higher number versus a lower number, we will adjust the returns that way. The next one that we simulated was in CF, and we had a sell where there were 23 special situations and only 6 of them were profitable. So we are going to say that there are 17 out of 23, a large number, profitable when selling these options. So this looks like this looked like a good situation for selling options. So we simulated an iron butterfly selling it at 4.05. We bought it back for 3.86, or for a profit of 19 cents. Represents 19 divided by 405 is 5%. And you can see these other 2 trades were also profitable. The total profit was 91 cents. The total percentages, again, that's probably not the way to do it, but let's go to the next month. Was February. We didn't have any signals in December and January, which are typically low earnings announcement months, at least at the beginning of the month. So in the beginning of February, we had 5 signals, one of which was indicating a profitable situation, but we didn't simulate this because the ORATs over implied wasn't in our favor. If we're going to be buying options, we want that to be above 1. Again, if we're selling, we want it to be below 1. So we had 3 potential opportunities here where we all sold. We made, these were all 3 profitable for a total of $1.10. The next month after that was March. March had 3 signals, all of which were below 1, so all of which we simulated selling. We did have a losing trade here in Quimedica. It's an ADR. Not much option volume here, less than 1,000. So we lost 80 cents on that particular trade. So a total loss of 49 cents for the March results. The results of all of them was making $1.50. We had 10 winners with 1 loser, or I'm sorry, there were 10 trades simulated, 9 winners and 1 loser. And then this report, I think, is an interesting approach to earnings. I think what it does is it tries to identify when there is leakage and how someone that is in the know might go in and buy calls, buy puts, change the slope, or buy options in general, change the implied volatility curve, or by trading options make the valuation extreme compared to expectations. And a lot of what we were seeing too, these people that have leakage not only go into the option market when there's going to be an extreme move, but also when they could tell when there's not much going on. For example, when earnings are coming out around expectations, that's a good opportunity to sell options, and it's a lot harder for them to get caught in that particular situation. So this is why I think that this earnings move works well to track these people and pile on, so you could be kind of in the know. For retail, this report is available for $1,000 per year, and you can get a free trial by emailing me. It's Matt Amberson, matt@orats.com. Please email me and we'll get you a free trial of this report. And thanks for listening.